Also, let's hit the ground running. Let's get Temple Ashaju, our business correspondent, to cross over to us from the trading floor of the Nigerian Stock Exchange. Temple, good morning. Welcome to the program. Let's chew this together. Last week, a very surprising 84 earnings were released last week, one of the heaviest since this current earnings season started. But those earnings, including MTN and other big names, failed to lift the equities market. That's quite a very surprising one there. Temple, run us through some of these stories for the week we just finished.
Yes, that's correct, Bosun. First, as you said, welcome back. It's good to have you back again, Bosun. But so those equities earnings actually came on board and not too good at all.
No, not too good at all. I was watching from just across the border. Yes. Those numbers, even though we had a few big stories in those earnings, including the share of Dangote flour and the rest of that, but it doesn't look like the sentiments of investors was that very strong, despite those earnings across the sectors, oil and gas, banks, insurance, telecoms, industrial, consumer goods, and all of that. But I'll leave you to run us through the numbers, as it were. Surprisingly, over-the-counter market, NESD made about 0.5% jump on its own NSI.
Yeah, that's true, Bosun, because we're seeing some diversification again, portfolio rebalancing. That's sort of what some investors are doing since they couldn't get the good side of the equity markets. They then decided to, give a check to what is going on at the NASDO to see, which is why we saw those gains there. But let's move on. So basically, we declined by some 0.21%. That's for week on week. On Friday, it was also a decline that we saw to 26,293.30, and equity capitalization settled at 12.79 trillion naira. If you look at the activity level, we saw some 1.51 billion units of shares traded for the entire 5 trading sessions for last week. That was valued at less than 17 billion naira. And of course, in total, we had 15,544 deals. If we go by the sectoral analysis, the banking segment of the market was down by 0.46%. We got the consumer side of the market also declining some 0.66%. Industrial goods segment was where the gains began from, up some 1.05%, because we know that CCNN is doing a bit of a merger. Investors became bullish as well on WAPCO a little bit. But more importantly, the share buyback announced by Dangote Cement was a major reason why we saw investors' interest being renewed on Dangote Cement for the greater part of last week. Since that announcement came on board, we've seen Dangote Cement recording some gains. However, it's been induced by some level of profit taking, because you have some folks that have also invested speculatively on the Dangote Cement in recent times. So the more investors were putting their money on Dangote Cement, the more we saw some smart investors also trying to take profit and getting out of the market. The insurance side of the market was also positive, up some 33 basis points. We saw oil and gas rising by almost 5% last week, week on week. Why did we see the increase on oil and gas? Because Seplat during the week also experienced some good bargain hunting, and that was positive. It was able to pay some investors in that side of the market. We also saw O&O also making a record 8.36% on Friday. That was also enough for a little bit of profit taking for some investors, even though we know that that's something that some investors will still feed on this morning in the market. But this takes us to the NASDO to say, as Bosun hinted earlier, that was up by some 0.50%. Market capitalization still hovering around 502 billion naira. But of course, the value of transactions was 7.43 million naira for the entire transactions we saw last week. 22 deals was in total what we saw, and of course trading occurred on 6 out of the 39 securities that are tradable on that platform. We saw WAMCO, we saw Niger Delta Exploration Production Company, CSCS, and of course Afriland as dominant players for the week. which has ended. Now, for the fixed income side of the market, beginning with bonds, Friday was a bit bearish for bonds. Average benchmark bonds yields advanced by some 42 basis points on Friday alone, but it expanded by some 87 basis points week on week. Average yields on some securities that you have there, the March 2027 and of course July 2034 security was a bit of expansion as well. 57 basis points expansion was what we saw on the 2034 bond, the 2034 paper for the entire week. If you look at the key numbers that we have there, the bills, the papers that you have on screen, we saw 5 deals basically for on Friday alone, and of course that explains the lackluster performance of the market. Treasury bill side of the market was a bit mixed on Friday. We saw yields moderating 22 basis points on Friday, but 59 basis points on the weekly analysis, and yield on the 342-day to maturity paper actually shed 319 basis points. Bosun.
Yes, Temple, quite a lot to chew there. But again, we'll have an outlook for the current trading week with you. This is the first full trading week of the new month. Thank you so much, Temple Ashaju from the Stock Exchange trading floor. But again, sticking with the Nigerian stock market, what's the playbook for the equities market in the month of November? That's what Adedayo Bakari, investment analyst at Afrinvest, is talking to us about this morning. You heard about those earnings, they're coming in droves, but the investor sentiment spat last week. Perhaps a bit of end-month adjustment, but year-to-date, we're negative nearly 17% on the local bourse. That's very significant for the year. So we're now down to the final 60 trading days. If you take away the weekends, it's far less than that. So how do we trade the market for the remaining part of the year and this month, to be specific? We still have expectations of more earnings coming through. So that's what Adedayo Bakari is talking about when he's joining us for this conversation right now. Adedayo Bakari, good morning. Welcome to the show. Hope you had a very great weekend.
1 2.
Yes, 1 2 1 2. Let's get it started. Let's get the show on. Adedayo, what's your take on the month we just finished?
Okay, so October was, a turbulent month as well. We've had, throughout the year, since the elections, since the conclusion of the elections, we've had, continuous, bearish sentiment in the market, and that was what we saw, in October as well. Now, I think October got interesting a bit later into the month due to all kinds of CBN policies issued by the CBN during the month. Also, we know that the recent border closure by the federal government of Nigeria too has affected sentiment somewhat, and we expect that with the extension of the border closure till January 2020, we believe that will continue to affect investor sentiments in the market. So generally, October was not quite a good month for equities. We continue to see more participation in the fixed income market, and but with the recent policy restricting corporates, individuals or non-bank financial institutions from participating in OMO auctions and in OMO sales and purchases in the secondary markets, we might see a bit more participation in equities going forward.
Okay, it's been soft so far this year, but again, we can do very little about where we're coming from when it comes to the equities market. When you invest in equities, you're basically looking forward most of the time. So let's look forward for this new month. Any particular news or earnings or developments that you think, whether from the fiscal space, from the monetary authorities, we're going to have the final MPC meeting in about 3 weeks from now. So what's on your playbook? What's on your radar for this new month? We're getting fully on steam starting from today.
Okay, so in November, we're going to see some of the companies yet to release earnings, publish their earnings for Q3. For the financial reporting period applicable. Now, in November, we think a lot of what we've seen throughout the year will continue to play out. But on the macro and the fiscal and monetary space, we think there are interesting developments that could shape how investors trade in the market. Now, in the fiscal space, we know the government continues to drive revenues. They're trying to come up with all kinds of policies to improve revenues. So I'm watching this space for what the federal government will be coming out with. Also, budget deliberations in the National Assembly are expected to continue. So we expect a bit more, swifter pace in budget deliberations, and hopefully, we are hoping for an early, passing of the budget in the National Assembly. Now, in the macro space, we're going to be seeing a lot of data releases. The inflation has been on the uptrend since September. It's likely we see a sustained, trajectory in October, especially due to the recent border closure, where food prices are now very, very high. Even the harvest season would only offer a bit of a reprieve, but generally we believe prices will be on the increase. Also, in terms of numbers for GDP, we're going to see how the economy actually did in Q3 2019. In terms of how household, consumer spending and income, we're going to get a bit more sense into that as well. And finally, closer to the end of November, we're going to get a bit more sense about the CBN's, monetary policy going forward towards the end of the year and going forward. So we think, generally, investors would like to think about the general macroeconomic environment and balance that with what the CBN is doing and what the government is doing. And currently, we believe these institutions are not doing enough, to boost confidence in the market, and we could see a bit more soft participation in the market. So for November and going forward, we do not expect, a significant upturn in the market.
Okay, Adedayo, the big, well, not really big. We haven't really decided whatever happens to the minimum wage. Would that be a point of note for you when it comes to equity market investing? There'll be hundreds of billions, in fact, trillions of naira, which the central bank will be repaying in mature treasuries between now and December the 31st. So do you see this money is the minimum wage, at least at the federal level, until the state governments get their acts together and decide what to do with the labor? Do you think there'll be some measure of liquidity that some of this could find their way into the custom street where you are currently seated?
It is a possibility, but a remote one. Just last week, we looked at, in view of, the recent policy guidance by the CBN restricting participation in the OMO market, we actually looked at the opportunities in the equities. And one of the things we saw was that, for banks and for some telcos like, MTN, industrial goods company like Dangote Cement, there are actually opportunities for, investors to earn very good returns. This is in terms of dividends. So we have companies with very strong track record of paying dividends. And for most of these companies, say if you look at the likes of Zenith Bank, UBA, MTN, Dangote Cement, the dividend yield on these stocks are around double digits. So which is in some situations even higher than what you would get in the treasury bills market. And we know the earnings season is going to, dividend paying season will come, in the very near term. So for us, we could see, a bit more participation in equities, especially in stocks with, very strong fundamentals and opportunities to earn very high dividend yields. That is really the space we think investors would like to play in. But for us, generally over in the market to even, very high liquidity in the system and very limited supply of paper, we think yields will continue to go down. Treasury bills market, the bonds market will still be the prime, investor destination for most of the, Nigerian pension funds, insurance companies, and even local corporates and individuals. But lately, we've been seeing a lot of policies in terms of for the government in terms of the reforms. I think investors will watch out for that too. If there's a significant improvement in terms of reforms that could, improve growth and earnings in the market, and as well as, remove a bit of uncertainty and reassure investors, we could see more flows into the equities market. But until then, we believe fixed income remains the safe space to play in.
You're the one doing all the analysis. Adedayo Bakare, I'm the one sitting down here reporting where money moves. So you guys tell us where the money moves, whether small, big, whatever, we just follow the money. Thank you so much. Have a great day. And we thank you for tuning off the current trading week with some of these analysis for our viewers here and around the world. Thank you, Adedayo Bakare from AfroInvest. Okay, so let's talk a little bit about the UK market. A new report is out that the UK economy will grow less than earlier forecast, 1% from 1.5%. And that's hitting the market straight this morning. Juliana Olayinka, my colleague from our London studios, is standing by to bring us up to speed on these and a few other topics we're talking about over the next few minutes within the show this Monday. Juliana, good morning. It's good to see you. Hope you had a very nice weekend. Welcome to the show.
Welcome back, Bosun. I had a lovely weekend. Thank you.
Thank you. So let's just hit the ground running, as it were. So this report is about the UK economy being slashed a little bit from 1.5 to 1%. Can you flesh that up for us a little bit? Where is this report coming from? And then why will this economic revision take place? On what basis?
Well, uncertainties in a weak global environment are weighing on the UK economy. That's the headline from Ernst & Young and their autumn outlook, really looking into the UK economy into 2020. And they've urged businesses to basically forecast slower growth in the UK next year. What they've done is they've had a closer look at Boris Johnson, the Prime Minister of the UK's withdrawal agreement with the EU. And they are taking into account that we may indeed leave on January the 31st, 2020. And when they've had a greater look into the withdrawal agreement, they foresee that having a looser relationship with the EU will lead to slower growth. They said in comparison to Theresa May's deal, which of course was rejected 3 times, that stronger relationship with Europe would deem the UK being bigger and brighter. They've also taken into account 95% of economists, and we've had these discussions many times, Bosun. Several people that are analysing the Brexit process do believe that remaining, whether you like it or not, would be better for the British economy. But it's not just Brexit. They've had a look at other things, such as the trade tensions that are going on across the world. That's affected the 2 largest economies, US and China. So, of course, Britain are not immune from that. And they also spoke about business investment. Now, out of the 5 of the 6 last quarters, business investment in the UK is on decline. We have had good labour reports over the past few months, but they also suggest that that's likely to decrease over the next couple of months. And when it decreases, you can't expect consumers to try and build up the British economy. So a 1.5% slash to 1% is not great, but the headline is businesses in the UK should prepare for lower growth.
Yeah, well, part of this entire broader economic story, perhaps feeding into what the news is also this morning, that the KPMG, one of the biggest accounting and advisory services in the world, will be taking about 65 out of their partners. Not so much of a Merry Christmas for those folks, I'm sure, letting them go by November. So, what's the behind-the-scenes story here at KPMG? Why are these 65 partners being asked to go?
Well, this is an interesting story. KPMG, as you said, one of the big 4 accounting firms in the world. They've been in the headlines a couple of months now, and that's because last month they launched this Project Zebra £100 million cost-cutting drive. And according to a report from the Financial Times this morning, they will be releasing 65 of their partners. Apparently, there was a review of performance, and some of these reviews was looking at just how much you were charging your clients, not charging them enough, then you're on the chopping list. But KPMG have been very quick to rebuff and reject this account from the Financial Times, saying that it's quite the contrary, that they have no plans of axing people in the next 2 months, which means jobs may be safe for Christmas, but in the new year, it may not be so. And they actually said what they've done is take on a further 100 partners. And they said if you look at the 65 numbers that the Financial Times are quoting, this could be people that are moving on to senior roles or could be retiring. So they didn't necessarily say that 65 jobs will not be going, but they certainly said that they will not be going before Christmas. But KPMG are in a massive period of trying to cut costs, particularly because, you know, the climate and technology are really weighing in on businesses in the UK now. They have to try and limit anything that is going to cut emissions, and sometimes certain jobs that are deemed as useless by some reviewers will be going shortly.
Yeah, Juliana, just a quick one. We have about less than a minute to wrap this up. I'm just asking, if we just can't eat in peace, what's the problem with Just Eat?
Well, Just Eat, the online takeaway giant, always in the news these days. Two big stories for them. One is the fact that this new technology tax, the UK government, the Conservatives are trying to add a 2% tax to any big online giant that's raising a certain amount of money in the UK. Just Eat is one of them, and their chief financial officer is not happy that they'll have to pay £7 million a year more on that. And of course, at the moment, they're in a bidding war between a South African process company and their Dutch rival Takeaway.com. Takeaway.com likely to get it, but Just Eat are in the news for all the right and wrong reasons today.
Okay, we can just eat later, lunch. Thank you so much, Juliana. Have a great day. Okay, so let's take a quick break, everyone, and then we'll be back in 2.